5 Important Stock Investing Tips. Purchasing stocks is simple. Selecting businesses that consistently outperform the stock market is difficult. That is something that the majority of people are unable to perform. The ideas listed below will provide tried and true guidelines and tactics for stock market investing. 1. Leave your feelings at the door. Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing. That investment advice comes from Warren Buffett, a frequently referenced investing sage and an inspiration to anyone looking for long-term, outperform the market, wealth-building gains. One of the most frequent ways investors reduce the returns on their own portfolios is through excessive trading activity brought on by emotions. 2. Choose companies rather than ticker symbols. It's simple to overlook the fact that there is a real company operating behind the alphabet soup of stock quotes that crawl along the bottom of every CNBC show. Buying a share of a company's stock makes you a part owner of that business. You want to know the company's operations, position in the market, competitors, long-term prospects, and whether it adds anything new to your portfolio of existing firms. 3. Prepare for stressful situations in advance. Making snap judgments might result in the classic investment mistake of buying high and selling cheap. When your mind is clear, list the factors that make each stock in your portfolio deserving of a commitment as well as the situations that would warrant a breakup. For example, why I'm buying, describe the aspects of the business that appeal to you and the opportunity you perceive for the future. What do you anticipate? What benchmarks and indicators will you use to assess the company's development? What would compel me to sell? There are valid reasons for breaking up on occasion. We're not talking about stock price fluctuations, especially not in the short term, rather, we're talking about fundamental adjustments to the company that have an impact on its capacity to expand over time, such as when the CEO's replacement starts running the company in a different way. 4. Gradually add positions. The most successful investors purchase stocks with the expectation that they would be rewarded over years or even decades through share price growth, dividends, etc. The following 3 purchasing methods will lessen your exposure to price volatility. Dollar cost average. Dollar cost averaging is the process of investing a predetermined sum on a regular basis, such as once a week or month, buys more shares when the stock price falls and fewer shares when the stock price rises. But overall it balances out the average price you pay. Buy in thirds, as the name suggests, choose 3 different points to acquire shares after dividing your desired investment amount by 3. These may be based on performance or corporate events, or they may occur at regular periods, such as monthly or quarterly. Buy the basket. The strain of selecting the one is reduced when buying a basket of equities. If you invest in every player who passes muster in your analysis, you won't miss out if one succeeds, and you can utilize the profits from that winner to make up for any losses. This tactic will also assist you in determining whether business is the one, allowing you to strengthen your position if necessary. 5. Avoid overtrading. Avoid constantly glancing at the scoreboard. This can cause you to overreact to recent events, concentrate on stock price instead of corporate value, and feel as though you must take action even though it is not necessary. Rarely is short-term noise, blaring headlines, temporary price fluctuations, relevant to how a well-chosen company performs over the long term. What counts most is how investors respond to the cacophony. Your investing notebook can help you persevere through the inevitable ups and downs that come with investing in stocks. It can act as that logical voice from simpler times.